Hi, everybody, and welcome to our third quarterly investor call of 2021. This call is being recorded and will be available for replay by visiting our website, www.o'keefestevens.com, and clicking on the resource tab and then selecting the value conversation link. Before we get started, we must remind you that the purpose of today's call is educational and the material presented is publicly available information from sources believed to be reliable. The information in this material may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. This call will be available for replay on the O'Keefe Stevens Advisory website located under the Resource tab. Please contact us if you would like a link to the recording of this call or any previous calls.
Thanks, Carly. Well, good afternoon, and thank you for joining us on the third quarter call for 2021. Today, we'll be discussing market and economic updates, and Peter will spend some time on the resurgence of value stocks over the past 12 months. Our investment review will focus on the recent news relating to the Supreme Court decision regarding Fannie Mae, and we will provide our updates for how our team plans to proceed with this investment. And finally, we'll address any questions at the end of the call. As a reminder, you can type your questions into the chat box during the call, and we will address the questions in the order that they are received. As America continues to recover from the COVID-19 pandemic during the first half of 2021, the economy and the equity markets made significant progress. At O'Keefe Stevens, we believe the most important thing is to stay long-term, goal-focused, and plan-driven. We own stocks for the premium return that they provide over the other types of investments, and we fully understand that volatility is the price we pay for those premium returns. To weather the storms of volatility, we've found that the best course for us is to formulate a financial plan and then build our portfolios based not on the view of the economy or the markets, but rather on our most important lifetime financial goals. U.S. stocks in general have appreciated about 70 times since 1960, and the cash dividend of the index has gone up about 30 times. Over that same period, the consumer price index, or inflation, has increased by a factor of 9. So equities have and continue to be the most efficient hedge against long-term inflation and real generator of wealth over time. And our team, we believe this is going to continue in the long run. And it's why our investment policy of owning stocks in well-financed businesses remains unchanged. By acting continuously on a financial plan rather than reacting to current events, we have the best chance for long-term investment success. So unless our goals are changing, we really see little reason to alter the financial plan. And if the portfolio we built is well suited to the financial plan, we're not making significant changes to that either. So before I get into our current observations about the economy and the markets, I think it's important to state that we don't believe in forecasting or timing. It's just not possible to do these things consistently. As I said before, we're convinced that the most reliable way to capture that outsized long-term return of stocks that you see up here on the screen is simply to ride out their frequent but ultimately temporary declines. I don't think I can say it any better as this chart tells us the story on the screen. The big decision that we need to get right is to keep owning equities because of this substantial long-term results when you compare it to fixed income. We're investing for the long term with our clients, and we want to own the assets with the best opportunity to perform during that time frame. Another point here is the performance of our portfolio relative to any benchmark is irrelevant to investment success as we define it. And we really have no control over it. The only benchmark that we care about is the one that indicates to us whether you're on track to achieve your financial goals. We're focused on installing successful habits and behaviors, and we want to make minor adjustments to keep you on track. And when we make this shift in our focus, we take control over the things that matter in our lives, and we get to eliminate the unneeded efforts or stress in the areas over which we have very limited influence. So moving on to current observations.
Okay, sorry about that, everybody. I think we were having some audio issues with our dial-in, so we've switched audio sources here. We're going to move on to current observations. The American economy continues its dramatic recovery in the first 6 months of 2021. Effective vaccines continue to be more accessible in the United States and around the world. And the Federal Reserve provided massive monetary stimulus to accommodate the big interruption in our economy. And the economy actually showed how fundamentally resilient it is when the world changes. And we think this is a quality which should never be underestimated. Equity markets across the board are up since the end of 2020. And over the prior 12 months, the improvement is even more dramatic. US stocks are recording record earnings in 2021, and their dividends are being restored and starting to be raised now that the uncertainty is being eliminated. There remain struggles with supply chain imbalances, and there's a historic mismatch between the number of jobs available and the continued high level of unemployment. Although we are starting to see the unemployment rate declining rapidly, there continues to be much speculation about when these problems are going to resolve. And to long-term investors like us, it's not so important as to when the resolution comes, as much as it is the belief that this will improve over time. We're still in the midst of an unprecedented experiment in both fiscal and monetary policy. The possibility that we overstimulated the economy was highlighted this spring with a significant resurgence in inflation. Cars, homes, materials recorded price increases that haven't been seen in decades. But as the first half of the year ended, the Fed chairman came out and stated that there's a keen awareness to this risk, and they stand ready to act against it. Markets took these remarks for their word, and inflation hedges like gold and oil sold off. We saw stocks pull back modestly, and the yield of the 10-year Treasury dropped to just 1.5%. Couple of other things. There's also the issue of the Biden administration's somewhat radical tax proposals with respect to capital gains and estates. And the best thing that can be said on this subject is that as the first half of the year ended, the momentum behind these initiatives seems to be fading a bit. But the political climate remains as unwelcoming to capital and capitalists as it has been in quite some time. So for long-term investors like us, I think the most important economic report for the first half of 2021 came in June. That was that household net worth in this country spiked 3.8% in the first quarter of 2021 to $136.9 trillion. That was propelled by gains in the equity markets and home prices. Even more important is the fact that the ratio of household debt to assets continues to fall, and we're now back to where it was about 50 years ago. The U.S. consumer powers this economy, and the consumer has rarely carried more manageable debt levels relative to its disposable income. The U.S. households have never been holding more cash than we see today, and in June, the National Retail Foundation raised its outlook again, and it now expects retail sales to grow 10.5% to 13.5% year over year. That's 4.4 trillion to 4.6 trillion year over year. And we're seeing the affirmation of these results in retail stocks and the real estate entities we own in this space. Looking back on February 19th, 2020, that was the market's peak just before the pandemic took hold. The S&P 500 index closed at a record 3,386. From there, it proceeded to decline 34% in just 33 days during the world's worst global health crisis in over a century. But if you bought the index at that top on February 19th and you just held on to it through June 30th of this year, your total return with dividends reinvested was close to 28%. And very rarely do we get such a vivid demonstration of why we want to hang on to stocks. And I'll quote Peter Lynch, who's a legendary investor, who said, "The real key to making money in stocks is just not to get scared out of them." And we believe it's part of our mission as your advisors is to help you not get scared out of the stocks that you own. And we just want to say thank you for heeding our advice over the past year. It's our privilege to do this work alongside you. Peter?
Thanks, Justin. At O'Keefe Stevens Advisory, we approach investing with the perspective that common stocks can be mispriced. The objective of our in-house research is to find companies trading at significant discounts from what we believe their value to be. Naturally, this means owning investments that are temporarily out of favor, such as companies with disappointing short-term earnings or negative headlines surrounding the business or industry. Wall Street labels investors like us as value investors. For the majority of the past 10 to 15 years, growth investing significantly outperformed value investing. The reasons are numerous, and it's impossible to say exactly what caused this disparity. However, many believe that low inflation coupled with low interest rates are important reasons. High growth companies can fuel their growth with low cost borrowed money, and risk to investors is low because of the access to funding. When these tailwinds change, growth investors tend to fall out of favor as the risk and more fundamentally sound businesses become more attractive due to their safe balance sheets and more stable earnings. One reason for owning investments we choose is our alignment with Benjamin Graham's definition of an investment. An investment is one which, upon thorough analysis, promises safety of principal and an adequate return. Investments not meeting these requirements are speculative. We are simply attempting to buy good quality businesses that are on sale. In October last year, the performance spread between growth and value was near an all-time high for a 15-year period. Growth investments' total return was approximately 12% compared to 7% for value investing, approximately a 5% annualized difference. But if we look at the same chart from June 4th of 2021, with inflation looming on the horizon, value investing has begun to outperform growth investing as investors have shifted from the more speculative companies to companies with tangible assets and positive earnings and profitability. Investors are beginning to perceive the risk we see with the growth strategy is real, and the environment is shifting in favor of our value philosophy. According to this report prepared by First Trust, the data shows that year to date, value investing has returned just over 34% and growth investing just over 5%. We invest in what Wall Street calls value investing because we believe we are buying a dollar in value for 50 cents. This provides us with a margin of safety and allows us to sleep well at night. We continue to believe that the best approach to guiding our clients to successfully reaching their long-term goals is by owning great businesses at discounted prices. Holdings in our portfolio are a testament to these figures. Here's a sheet that shows the top 10 positions we were adding to in November of 2020. Dominic and I update this list monthly to get our team on the same page with us and where we're seeing opportunities. It also helps us to understand how our selections are doing over time. Looking at the sheet, you can see several of our top holdings are up considerably over the 8-month period. For example, Bank of Ireland, 5 Point Holdings, and Kimco are all up over 100%. Virtually all the value stock we were buying were trading at exceptionally low levels, and we backed up the truck, so to speak, to buy into these positions whenever we could in the year 2020. It's important to remember that one style of investing will never always be on top. The reason is simple. Performance drivers are period specific, hard to predict, and unlikely to be repeated. Investors who jump from style to style after seeing one strategy outperform the other are particularly vulnerable to disappointing returns of events. We have a chart here that shows the results of different types of equity strategies over the past 15 years. We've inserted a yellow highlight line to show the results of value compared to other styles. Over this time frame, momentum and growth strategies perform best. But if we look beyond these 15 years, value investing has prevailed over longer time frames. The circumstances of previous decades sent growth stocks to record high. The wave of technology innovation, the emergence of cloud computing, and the acceleration in e-commerce and the migration to mobile computing have transformed the global landscape. This once-in-a-generational shift drove growth stocks to new heights, led by global technology platforms. In 2018, the dominance of growth stock was further strengthened by the collapse in the 10-year Treasury yield, which hit an all-time low in March of 2020 of 0.54% during the early days of the pandemic. These lower bond yields make the value of further earnings for growth stocks more attractive. For all these reasons, investors piled into growth stocks and shunned value stocks. This left valuations of companies in the value category at their lowest level seen in 2 decades. Last year was the most attractive time to add the values that I've seen in my career. And stocks came back with outstanding performance during the past year. From September 2020 through the end of April of 2021, the Russell 1000 Value Index gained just over 31%, more than double the 14.4% return of the Russell 1000 Growth Index. The focus needs to be on sticking with whatever strategy you select, whether it's underperforming or outperforming. Your long-term goals will be achieved when you do this consistently, and that's what it's all about. The winning strategy is not our objective. We do what makes most sense to us, and it's to invest with our circle of competency. This allows us to shun out the noise of the media and other pulls on our attention, and to stay with our strategy through the ups and downs of the market. Next, I want to spend some time explaining what happened with Fannie Mae and what our thoughts are for the position in our portfolio. Keep in mind this setback was disappointing and produced only a nominal impact on the portfolio's value due to the size of our position in these holdings. Because it was a special situation investment with different risk than our other businesses, we intentionally maintain a right-sized position to accommodate the additional uncertainty in the outcome. On June 23rd, the U.S. Supreme Court issued a decision in the Collins versus Yellen. This case was an important factor for the shareholders in both the common and preferred shares of Fannie Mae. The justices ruled unanimously regarding the unconstitutional nature of the Federal Housing Finance Agency, seemingly a win for shareholders. However, the justices ruled against the major issue at hand for making shareholders whole on their investment, the unconstitutional nature of the net worth sweep. In addition, shortly after the ruling, President Biden replaced Mark Calabria, the Federal Home Loan Agency Director, with Sandra L. Thompson. Calabria was appointed 2 years ago by President Trump to execute the plans to privatize Fannie Mae. This decision will further delay the process. Given this setback, the common and preferred shares have declined significantly. While this decision is a major setback, it does not mean our investment will evaporate. The companies continue to be extremely profitable and will need additional capital to meet their regulatory requirements. In addition, it is estimated that over $100 billion is needed to make the companies viable and sustainable. As common and preferred shareholders, we will continue to be an important piece of the capital structure. the company will continue to operate as a backstop to our nation's home finance businesses. Because of this, the shareholders of both the common and preferred will remain engaged in the dialogue of how to raise capital for Fannie Mae. Our thoughts are to remain invested and to continue to analyze the information as it's unveiled. We do not know the direction of the new Federal Home Loan Finance Agency will take at this time. Speculation suggests the release of the conservatorship is going to be delayed, but there is no evidence of this yet. We are waiting to see what other large shareholders in the company are doing with their preferred and their common share interest. Each quarter, we review the reports from other investors who hold our positions. When these reports come out, we'll know if some of our major holders are invested in the company or are still invested, or if they've sold out. We will also look for commentary from other investors to gain insight into the overall sentiment about the rulings and the position. There are a lot of moving parts to this investment, but the company behind it is incredibly profitable with close to $20 billion a year in pre-tax profits. These profits will likely be used to build the necessary capital to be released from conservatorship. So it's a matter of how long we need to wait. That will dictate our decision here. As we gain more details, we'll keep you informed with how to proceed. It is clear from the price drop that many investors have lost patience and don't want to wait any longer. But remember, there's a buyer on the other side of every selling transaction. We've told you before, patience is our competitive advantage as investors, and this situation is no different. We will stay patient and keep gathering the facts to make informed decisions. Carly?
All right, thanks, Peter. Now we're going to move on to the question and answer section of the call. We did receive one question prior to our call in regards to Kimco's merger with Weingarten Realty. Dom, can you speak on that for us?
Sure. Thanks, Carly. So Kimco and Weingarten agreed to merge in mostly a stock-for-stock deal where each Weingarten shareholder will receive 1.4 shares of Kimco plus $2.89 in cash. Kimco shareholders are expected to own approximately 71% of the combined equity, and Weingarten shareholders will own around 29%. The transaction is expected to close in the second half of 2021, and the combined company will be worth around $20.5 billion. So in general, the demographic trends of an area will have a major impact on the value of commercial real estate over the long term. This merger will increase Kimco's presence in the Sun Belt markets such as Houston, Miami, Phoenix, Atlanta, and Orlando. These cities have positive demographic and migration trends along with strong growth prospects. The Sun Belt and high barrier to entry coastal markets such as New York, DC, and Philadelphia represents roughly 82% of Weingarten's rents compared to 42% for Kimco. So that's a pretty good improvement in the location of the assets. A part of the transaction, Kimco's leverage will decline slightly, which will improve the credit quality of the company. As a part of the transaction, the number of properties owned will increase from 400 to 559 properties. Cost savings, a part of the merger, will be around 35 to 38 million. And these savings are attributable to both companies' complementary business operations and significant regional overlap in the high growth Sunbelt markets where economies of scale can be realized. So overall, we view this as a good transaction. The price Kimco paid for these assets seems reasonable. The portfolio of assets is enhanced as location of Weingarten's assets are in high growth areas, and tenant diversification is improved, lowering customer concentration risk. We also believe there may be other opportunities for this acquisition to pay dividends in the form of lower financing costs due to the improved credit profile and potential cross-selling opportunities with existing customers. We will provide updates in the future once this transaction closes and as new information becomes available. Carly.
Thanks, Tom. So we do have another question. It states, it is clear that small stocks outstrip inflation. So for a customer in retirement, Does that mean that the percent draw needs to be higher, but that the investment base is bigger, offsetting the added draw?
I'll take a crack at that one. So, well, small stocks to start out have a higher long-term performance track record than large cap stocks. One of the things we know about them is that we also picking up quite a bit more volatility in general to own small cap stocks. So your question about in retirement, does that mean the percentage draw needs to be higher? I think it's somewhat unrelated. You know, our portfolio owns both large caps and small caps, and what we're really looking at is the total return. You could certainly make a case that, hey, if you had all long-term money, you would want to own mostly small cap stocks. But in retirement, one of the things you're also going to trade off there is that we don't necessarily get as much in the form of dividend income from small cap stocks. So we would be needing to sell off some principal investment in the small cap stocks in order to generate those returns. So really what we're looking for here is more of a balance, and that's going to influence the withdrawal rate that we're taking. There's more to it than that. I mean, your age is a factor that we need to take into consideration, but I think it goes back to what we said in the beginning is we want to put together a plan that's conservative, that we feel meets the objectives of your long-term financial goals. And then we build our investment strategy to support that. So that's what our process is doing. It's not necessarily going to be influenced by the ratio of small cap to large cap. Kind of a long-winded answer, but do either of you have anything you would add? No? Thanks for the question.
Doesn't look like we have any more at the moment, but if you want to submit a question, just go to the question box and you can type one in and send it to us. We'll wait a couple more minutes for more questions to come in. All right, so we have another question. Taxes and inflation are enemy. Any comments on the tax situation?
You know, still waiting to see. You know, I think one of the things I've been saying that should be repeated here is that you have to remember taxes are an incentive model. And I mean that is where tax policy goes will incentivize investors, it will incentivize businesses, it will incentivize consumers on where to take their money. And so if taxes go up in one area, you can be pretty sure that money's going to flow away from that area and into other areas. We saw this, and Pete, you can probably give a more accurate depiction of what happened when taxes went way up on capital gains and people moved money into, you know, municipalities. It was a stagnant period for the economy because investors were looking for ways to avoid taxes on their investment income. So, you know, do I think that we have anything major to worry about right now? No, that's not where my head's at on the issue. What would you add to that, Peter?
I think we have periods of higher taxes and things. Naturally, investors will focus on where they can get a tax credit or tax deductions and things of that nature. And so in the early 1980s, after the Carter administration, taxes were significantly higher, and you saw movement into real estate to lower the tax burden for individuals. But as Justin had mentioned, there's always, when you have something like that happen, there's always consequences. Some of them are unintended and some of them are set up directly to encourage behaviors in a certain area. And so we'll continue to see that as well.
Okay, and it looks like we have another question related to if the droughts and wildfires are affecting any of our holdings or investments in our portfolio.
Specifically, probably Weyerhaeuser.
Yeah.
Dominic, you were just listening in on that, right?
Yeah. I don't think any of our areas have been affected. So if anything, it might be a slight positive if you take some supply off the out of the market. In general, prices will have to go up to compensate for that. Other than that, I mean, we've continued to see tight supply pretty much across every commodity. So right now, that's going to be a driving factor more than any of the wildfires that we're seeing.
Yeah. And the forests that Weyerhaeuser maintains are diversified across the United States as well. It's one other thing I would add. There's the forests in Georgia, so in the southeast United States, and then the Pacific Northwest. So maybe the Pacific Northwest might be a little bit more vulnerable. But the other thing to pay attention to here is that Weyerhaeuser has a massive amount of insurance on those forests, and they're well secured in the event of a natural disaster.
Right, and it doesn't look like we have any other questions at this time, so we'll wait another couple minutes, put ourselves on mute, and if you have a question, just submit it in the question box and we'll be happy to answer it.
Thanks for organizing.
All right, it looks like we don't have any other questions submitted, so we're going to end our quarterly investor call for today. As a reminder, you can send in any questions you'd like answered by Peter, Dominic, or Justin on this call in advance to any member of our team. We look forward to addressing your future investment questions on these calls. Thanks for tuning into our commentary on the market and your investments. You'll be able to replay a recording of this call within 48 hours on our website.